Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter like I normally do, or X, whatever it is, and look at the three topics that I like to cover: wealth building, financial topics, and commodities. Why commodities? Because that's where the value is. Under the market conditions that we're in, my opinion, where the valuations are at in commodities, that is the best risk reward area in the market that I know of. So that's why we're always looking at it. That's why I'm always trying to see where to put new money, where the chart patterns are breaking. And that's exactly what we're going to do today. We're going to see what other people think about what's going on in the market outside of my own little warped view of the charts that I look at and the data and the inventory levels, et cetera, et cetera. So let's dive in. Let's see what people are talking about, and I'll sprinkle in my opinions. If you want to follow me, it's at finding_finance. And if you want to join our community, finding-value.com, that's where we talk about individual companies and where I show you what I think are really ridiculous chart setups and patterns to take positions in and make a boatload of money. So we've got Uselink, and I'm going to try to get Casper on here over the next few days, see if we can hook up and get a video going over all these different sectors together. But what he's got here is gold, 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 gold. And he says wick, 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 no wick. What does this mean? Why is it such a big deal to break out of these resistance areas? Like, why does it matter? Because the psychological containment on gold is about to be broken. And when that psychological containment is broken, it's going to run like a cheetah. So we hit it, we hit it, we hit it, and then when we break, it's not just going to sit at 2068 of where it's at today. If we get a big breakout, which I think we will, then we're going to see a big run. And the price is probably going to go to, I don't know where it's going to go. $3,000, $4,000, $2,500. We don't know that. All we know is it's going to run, and we don't know necessarily the ultimate destination that it will end up in. But generally speaking, the bigger the base, the higher in space, what a lot of us say. I think Patrick Karam said that originally. But that's the general rule of thumb. And we're breaking out of this resistance psychological stranglehold that gold's got at this level. If I were to take a guess, I think we're going at least 2,500 to 3,000. Somewhere in there is my minimum. But here's the thing, guys. This is also psychologically driven. And if things get out of control, or if people get scared and people run at gold, 3,000 could be way, way, way on the low side. I don't know. Maybe we run to a level that's like 5,000 or 7,000 or 8,000 or even 10,000. So again, that's kind of the minimum that I think it will run, but I don't know what the maximum will necessarily be. But right now, this is the time to be looking at potential investments in gold and silver, either the physical metal itself or the companies. The companies like gold and silver mining companies and or royalty companies. But that's up to you, what you want to look at there. So Tavi says, and of course I'm going to be talking a lot about gold because that's breaking out. This was one of the most critical weeks for precious metals I can recall. Gold broke out from a triple top with authority, closing the week and the month at all-time highs. What comes next? Given the magnitude and scale of the current debt imbalances, gold in Japanese yen offers a valuable roadmap. A secular move in precious metals in the mining industry is likely in the making. A secular move just means that it's a long, big move, like a 10-plus year move. That's what secular means. Cyclical, with a C, is something that lasts for a few years, like 1 year, 2 year, 3 year. So he thinks this is a big, 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 big move. Now, what he's got here is the Japanese yen in the red. And he's got white as gold priced in dollars. So this is gold priced in yen. You can see how much it's going up. And that the dollar, gold priced in dollars is going to follow suit way to the upside. And one thing to kind of notice here, gold is the same, and it's the currencies that are falling. That is how you should view it. It's not gold going up. It's the currencies going down. It's the value of the currency going down against the ounce of gold that it's being measured against. So everything that we price all these things in, it is a dual measurement. It's a ratio. It is the 1 ounce of gold that you're comparing to against, which is in the denominator, the currency that you're measuring it against. The currencies are the things that are having problems. The gold is the store of value. And that's what you really need to wrap your mind around this. That's why I do all these ratios, to get out of the dollar, because the dollar's not a clear, clean measuring stick of value. This is a post. It says, investing is risky. Not investing is riskier. He says, over time, the biggest risk that you can take is to not take any risks. By Peter Thiel. Biden administration plans to buy 2.7 million oil barrels to refill emergency stockpile. 2.7 million barrels is nothing. It really is. He's got to fill hundreds of millions of barrels, and I have no idea how he's going to do that. That might also be the reason that we're seeing selling pressure in oil. Maybe they're trying to drive it down to get some sort of better buy point to refill the emergency stockpile with. I don't know. The market's now expecting 5 rate cuts of 25 basis points by January 2025. Expectation for the Fed have turned around in 5 weeks. The market itself has pivoted, and they're expecting rate cuts out of the Federal Reserve, and that's 5 25 basis point rate cuts by January of 2025. That's why we're seeing most likely the 2-year yield fall. The 2-year yield is front running the Federal Reserve. So it's already pricing that in, is what we're seeing. Scrolling down, we've got Lance, November inventory shift by year via Realtor. We can see that we've got a little bit of a shift in inventory to the upside for real estate, U.S. homes. You can see the seasonality here, the inventory gain, the depletion of the inventory gain, and then the cycle on a yearly basis. That's the seasonality. Then you've got the bigger overarching view that we're in, which is the cycle, the 18.6 year cycle, the real estate cycle, where we go into an expansion phase. Now, you can't really tell from looking at this that we're in an expansion phase. This is just active listings and inventory. But you can tell that we've got a little bit more inventory over here than we've got over here. So inventory is creeping up a little bit, just an FYI. Business inventory is nearing contraction levels. The last 3 times this has happened, it happened during the dot-com bubble, a financial crisis, and the pandemic. Each one resulted in economic volatility. So this is the business inventory reaching contraction levels, but we are looking for a potential turn. If it starts to turn like it did in 2016, maybe we come back up. Or maybe we go back down and continue to contract. Slow down and then maybe potentially contract. So that's where we're at, and that's the business inventory. Here is XAU, which is gold. in a Renko chart from Casper. He says getting above $20.75 creates a new Renko bar and confirms the breakout. So 2075, guys, is the breakout for all these technical analysis chart patterns. On a Renko chart, 2075 is a clear break. I'm already in this stuff. I really, I'm not waiting for a breakout. I'm just waiting for the market conditions to create the breakout that is occurring now. So I was buying later 2022 and onward. I've been buying the whole time. I've been cost averaging in. You could even check the website to see what I've been buying. And now we're going to enjoy, hopefully, a good ride in a gold and silver bull market, and hopefully platinum and palladium. I think platinum will definitely play along. We'll see what palladium does. But I think all the metals will do very well over an inflationary period. The Department of Hedonic Adjustments has been called up and issued Tensorfausts. So this is basically they can manipulate and adjust the consumer price index using hedonic adjustments. And he's just saying, get this guy out here because we need to adjust this thing lower in terms of inflation. And that is one of the reasons people think that the consumer price index is a completely useless metric to use because of substitutions and hedonic adjustments. Here's something, a little bit weird. Sugar is falling off a cliff to a 3-month low. And I know some people think that sugar and silver are highly correlated, but silver or sugar is falling the past few days while silver has been ripping to the upside. Divergence there. So let's hit this one up real quick here. It says, if it can be sliced an infinite number of times, is it really scarce? And I've made that comment before, and I don't think people understand the comment that I made. It's about Bitcoin, and in all honesty, guys, I don't really. Who cares about Bitcoin? It's about the philosophy, all right, the logic. You can always expand something double, 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 right? And that is infinite expansion. Think of that as inflation. But what if you can do that in an infinite number of times where you can cut something in half? You're just going backwards. Well, that is also infinite by definition as well, because you can always cut something in half. The problem is with Bitcoin is that all of the early adopters who adopted Bitcoin, they own the big chunk of all of it. So people are mad that inflation transfers wealth from poor people to those that create assets in the world. All right, so they own all these assets, and as inflation is created in the system by the currencies, currency value goes down, and value transfers to those who hold assets. Now, I want to know if Bitcoin can always be cut in half, and if you've got these guys that own all of this Bitcoin already, well, isn't that the same thing? I mean, isn't that exactly the same thing? So those guys, the way that they become wealthier is they need you and me and everyone else to adopt Bitcoin. And if we adopt Bitcoin and we get a fraction and a fraction of a slice of Bitcoin, they get richer because the total dollars running at Bitcoin go up. So my question then becomes, why would I invest in Bitcoin ever if there's already all these people who own it? Why wouldn't I just buy what everybody wants? They don't want Bitcoin. They want what Bitcoin can buy. They don't want Bitcoin itself. So why don't I buy the things that everybody wants to buy? Why don't I buy all of the actual wealth? Bitcoin is not wealth. It's a means to transfer wealth around. So what is wealth exactly? Well, wealth is it's land and that's it. It's either owning the land or the minerals that come from the land. All designs, all products are built with something. And that something is the wealth. Designs change over time. Designs can obviously be different, but they're still made out of the same key ingredients and components, which is aluminum, steel, iron ore, gold, silver, platinum, palladium, etc., 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 etc. That's what the wealth is. That is what everyone wants. They want the commodities in the correct configuration that they can enjoy. So, why would I go and buy Bitcoin and make people rich in Bitcoin that already own it versus buying the feedstock in the commodities that everyone wants to buy at the end anyway? They want to exchange their Bitcoin for a car. They want to exchange their Bitcoin for something of physical value uh, or a service. But all services will end up with physical items anyway. So all wealth is created by minerals coming out of the ground and being put into physical configurations that people can use. That's all I wanted to say about that. It says just in, interest rate futures are now showing interest rate cuts beginning in March 2024. There's a growing chance of rate cuts beginning as soon as January 2024 at 10%. Now, here's something that is interesting. These rate cuts are the exact same moment that the projections of the reverse repo are going to run out. So just an FYI. Government spending has been getting out of control. Spending as a percent of gross domestic product is now at the highest level in 60 years. It's at about 38%. We had 2011 was roughly the same time frame. And we had some good spending early to mid 90s, so on. The four most concentrated commodities by market share of top three producers. Now, this is crazy, guys. So think about this again. The four most concentrated commodities by market share of top three. The first one is platinum. So the most concentration of any market is platinum. Second is lithium. Third is rare earth elements. And fourth is cobalt. And here's something that also is interesting. If that is the case, that means that those are the most susceptible to a problem. Or you could look at it, if you invest in the companies that are most concentrated, for example, in platinum, and platinum were to go to some ridiculous level, and remember, platinum generally follows gold, and gold has broken out. So if platinum is the most concentrated, and I have the ability to invest in some of the most concentrated companies in the world, how do you think they're going to perform if platinum goes to the moon? They're probably going to perform quite well. That's the honest to God truth. So if platinum were to go to $10,000, $20,000, $30,000 an ounce, pretty sure the platinum companies that you invest in where they are the most concentrated are for surely going to capture those gains. That's the way that I view it. The housing market has deteriorated rapidly. Buying conditions are at levels only seen 2 times since 1960. And he's got a thread, but I want to focus on this chart here. So here, there was a recession in the late 60s, early 70s. That was a great buying opportunity for commodities. We came back up, we came back down. This was another really good opportunity to reload at commodities. I think there was a commodities boom here in the 80s as well. So if we're down here, and this here says people don't feel like buying homes today, buying conditions for housing as surveyed by consumers. This is a good opportunity to buy commodities. I mean, these were the biggest housing market booms in history here and here. These two, and we're at the beginning of what I think will be the biggest housing market boom in history. It's going to be bigger than the 1970s. The imbalances are bigger. How do I know that? Well, I could go pull up the XHB ETF. I could go pull up individual home builders. They're all at a lot of them are at new all-time highs. All time, not 52-week, all-time highs. How is that possible if we're in a housing market crash? It's not, because we're not in a crash. We're going to go up. People are positioning for lower interest rates and a housing market boom that is coming. That's why Lennar Corp, I keep going to Lennar Corp. Oops. Lennar Corp, all-time highs. There we are. See it? Monthly close, all-time high. That look bearish to you? Here, I'll put it on logarithmic. It looks a lot better on logarithmic. There we go. That look bearish. That indicating that we have a problem in the new housing market. No, it doesn't. Looks fantastic, guys. Says the breach in the line at 2000 is getting perilous for the central bankers. We're capturing unmanned trenches without a shot fired. Hearing that there will be an emergency diversity and inclusion initiative to try and hold the last line of defense at 2070, and it's obviously a joke. Let's do some diversity and inclusion here to hold this thing down, boys. Let's do it. Because that's going to work. New all-time high price in gold, 2090, printed in February gold contracts. So out in the future, we're also making all-time highs. Boom, Green Army showing up. This guy says that 2.75% mortgage rate sounds great and all until you are stuck in it because you can't afford to buy at a 7% rate. A great article explaining why many that are stuck in these low rates mortgages regret it. That sounds like hogwash, guys. That's complete BS. I've got a 2.75% mortgage rate. I love it to death. And it's a blessing because my mortgage is just cheap as all get out. It's like less than a third of what rent would be if I had to rent this same house. Less than a third. And these people are complaining about it? Are you kidding me? What babies? They have options with the 2.75% mortgage. You can live somewhere that is affordable at least. Imagine trying to buy a house today. Ugh, I wouldn't want that. That's the whole reason I got a 2.75% mortgage. It's the reason I bought a house when I did. It's the whole reason I put as much money down as I did, etc., etc., etc. And people are going to say, "Oh, you own a house? Well, what about the property taxes? Or what about the home insurance?" Yeah, okay, but my mortgage is one third. It's less than one third the price of rent. My insurance is peanuts. It doesn't cost hardly anything. It's like 2,000 something dollars a year. No, probably about 3,000 something now. Maybe it's 3,000 something dollars now. My property taxes are 3,000 something dollars a year as well. So, I mean, that's pretty dang cheap. And I'm locked in. Like I'm not going to move anywhere. I like where I live. I'm good. But if I were to move somewhere else, I'd just keep the house and buy another house. That's the way that I would do it. I don't need a mortgage. I mean, I could buy it out, but what's the point of that? It's really a small cost right now. So, I mean, if I were to buy something or go somewhere, I'd go to a warmer state, somewhere where it's a little warmer, and then just buy another house, I guess. But I'm a millennial, right? Well, all millennials are broke. Um, that's what everybody tells me. And I could easily buy a second house if I wanted to, without really trying. I could probably buy a bunch, but I don't. Millennials are broke, right? Yeah. How are they supposed to afford homes? Well, I can tell you this. I know a lot of millennials that already own homes. All my friends own homes, and we're all millennials. We're the older part of millennials, and we're not really struggling that much. The only people that are struggling are in their 20s, and that's where we struggle too. It's just you're early in your life. You're not supposed to come out at 25, 26, 27, 28 years old and be able to buy a house. Like that, not many people are able to do that. You have to save for 5 or 10 years before you can buy a house. So yeah, I rented for a while, and just like all my other friends, there were some smart friends that bought homes and then rented the rooms out in the house to other friends who basically covered their mortgage that way, which is smart. And I probably should have done that and thought about it. But people aren't supposed to buy homes at 25, 26, 27 years old. Unless, you marry someone who's older, but not the way it usually works. November saw the biggest easing in U.S. financial conditions on record, the equivalent of almost 4 rate cuts. And that's what I was seeing in the charts. I said, are they doing something with liquidity? Because we saw record easing in financial conditions in November, and we could see it in the charts. I mean, we can see it in copper and iron ore and all these other things. It's like, what is going on here? And maybe that's coming from the reverse repo and some of these other, deficit spending and all that crap. But I agree with that. We could see it in the charts, and we can invest based off of this. Here's 2020 CAPE rates. This is the actual CAPE index. Look at the red here, guys. Just ripping it in 2023 forward curve for the Baltic Dry Index. This is CAPE index. So companies like Starbucks Shipping and Golden Ocean Group and Ship and Safe Bulkers and Jenko Shipping and all these, Diana Shipping, they're just ripping it here, guys. They're ripping it. Here's the gold to silver ratio. The chart, and every precious metal investor is watching. The gold to silver ratio is about to break down from a multi-year coil here. I love it. This here is a flag pattern. It's a big flag pattern that's going to break to the downside. I think it just broke here recently. If it hasn't already, it's probably pretty close to breaking if it hasn't. But this looks really good for silver here, guys. This looks really, really good. Oil's been taken over by momentum traders who couldn't give a crap about fundamentals. You can see this not just in oil, but in oil equities as well, creating huge volatility for the few buy and hold investors remaining. It's now one giant casino with algos betting on trends. Though they comprise just 1/5 of managed money participants in U.S. oil, CTAs made up nearly 60% of the group's net trading volume this year. Algos, more broadly, are responsible for as much as 70% of crude trades on an average day, according to data from TD Bank and JP Morgan. You'd be absolutely shocked how large their positions are. They are probably bigger than BP, Shell, and Koch combined. They've roiled commodities from gasoline to gold, sidelined traditional investors, drawn the ire of OPEC, and even raised eyebrows at the White House. In 2022, the CTA trading volumes rapidly expanded. New York oil futures posted a more than $2 daily move 242 times. That's 150% higher than the historical average since 2000, according to Bloomberg. But what's so surprising about the continued volatility in 2023 is that it's come without the major shock to supplies that followed Russia's invasion of Ukraine. While Israel's conflict with Hamas set markets on edge, it's not yet had any major impact on oil flows, and rallies buoyed by production cuts from the Organization of Petroleum Exporting Countries and its allies have been undercut by CTA activity. Algorithmic trading for U.S. oil in 2023 spikes. The average percentage of net managed money positions, or CTAs, were over 90% engaged. And you can see it in 2023 being profoundly higher. This is what's causing these big moves in oil, specifically to the downside recently. And I was just kind of looking at it. This is, oh, we already talked about that. So that's where I'm going to end it, guys. That's what I've got for today. Give me a thumb up for the content. Subscribe to the channel if you'd like. Subscribe to the website. We still got the turkey deal going on. I'll leave it open for a couple more days. So that's what I've got. And commodities still look fantastic. Precious metals, fantastic. Oil still, it's hanging in there. It's trying to put in a bottom. Coal's looking great. Most everything looks really good. Iron ore, the easing conditions, I think, is a part of this. And I also think that the declining interest rates are going to be inflationary as well as they continue to decline. Mortgage rates have also declined quite rapidly. We went from 8 to 7% quite quickly here. I don't know what it is today, but it could even be below that. So that's what I've got for today, guys. Everything's on the up. It's looking good. Catch you next time. This is Finding Value.